Somewhere in Shanghai, a number just turned red, and it wasn't supposed to. Billions of dollars vanished in minutes from the one fund everyday people trusted the most. But here's the strange part. The price of silver itself was still rising. So how does a market crash while the asset behind it keeps climbing to new highs? Something is broken. And in the next few minutes, you're going to see exactly what it means for every business, every factory, every investor on the planet. Because what happened in China this week was never really about China. Alright, before we get into this, welcome back, friend. If this is your first time here, you've found the right place. This channel is called John A.G., and every single week we sit down and break apart the biggest stories in money, markets, and business. Slowly, carefully, the way it should be explained. Now listen, if you're the kind of person who likes to actually understand what's happening in the world, instead of just scrolling past it, do an old man a favor. Hit that subscribe button. Think of it like this. Imagine a wise old neighbor, someone who's seen 50 years of markets rise and fall, someone who always has good advice when you stop by his porch for a cup of tea. That's what this channel wants to be for you. So don't walk away from the porch. Stay a while. Subscribe so you never miss the next conversation. And one more thing before we begin. Drop a comment and tell us where in the world you're watching this from. It's always something special seeing this community stretch across every time zone on Earth. Now, let's get into the story. It started with a number, $70. For years, people who followed silver closely talked about that number like it was a myth, a ceiling nobody could touch, a line drawn so high most traders assumed they would never live to see it crossed. Then, this week, it happened. Silver did not simply touch $70, it broke straight through it. And within days, the price climbed even higher, reaching a level never recorded before in modern history. For a moment, it looked like a celebration, a victory for everyone who believed silver was undervalued for decades, a moment worth remembering. But on the other side of the world, something very different was unfolding. In China, there existed a single fund, the largest and most trusted way for ordinary people to invest in silver. For months, this fund had been on an extraordinary run. Investors poured their savings into it, watching its value climb higher and higher week after week. It felt unstoppable. It felt safe. Then, without warning, it collapsed. In a single trading day, the fund dropped by the maximum amount allowed by law, a full 10%. Money that had taken months to build disappeared in hours. And the people who managed that fund, the very people responsible for protecting investors' money, came forward and admitted something that shocked everyone listening. They said the recent gains had been unsustainable. Think about that for a moment. The people running the fund, the experts, the professionals, were telling the public in plain language that what had just happened was never built to last. So now the world was left staring at two realities that seemed impossible to hold at the same time. Silver, the actual metal, was hitting record highs across the globe. And yet, one of the largest silver investment funds in the world had just suffered one of its worst single-day losses in its entire history. How could both of these things be true at once? This is where the real story begins. Because what happened in China was not simply a local accident, some isolated event confined to one country's stock market. It was a signal, a warning sign flashing quietly beneath the surface of a much bigger global story. Somewhere between record-breaking prices and record-breaking losses, a fracture had appeared. And fractures like this one rarely stay contained. They spread. They ripple outward, touching industries, businesses, and everyday decisions far beyond the borders of where they first began. For the ordinary person watching prices rise on their screen, this might look like nothing more than a normal market swing, the kind that happens every few months and is forgotten just as quickly. But for those paying close attention, for the entrepreneurs, the business owners, the people who understand that markets are early warning systems for the real economy, this was something else entirely. This was the first crack in a structure that had been building pressure for a very long time. And what happens next, how this fracture spreads, what it reveals, and who it affects, is a story that touches far more than one country, one fund, or one metal. It touches everyone. To understand what really happened inside China's silver market, one has to look past the headlines and into the mechanics of what was actually taking place behind the scenes. The fund at the center of this story did not simply track the price of silver. It was supposed to. That was its entire purpose, a mirror, reflecting the true value of the metal it held. But somewhere along the way, that mirror became distorted. At the beginning of the month, the fund was trading only slightly above the actual value of the silver inside it. A small gap, nothing unusual. But as more and more money rushed in, driven by excitement, by fear of missing out, by stories spreading across social media and trading forums, that small gap began to widen, and widen, and widen. Within just a few weeks, people were paying nearly 60% more for shares of this fund than the silver inside it was actually worth. 60%. Imagine walking into a store and paying $60 for something that was only worth $37, simply because everyone else in line was buying it too and nobody wanted to be the one left behind. That is, in essence, what was happening. This is where the twist enters the story. The people managing the fund saw this happening in real time, and instead of celebrating the surge of new investors, instead of encouraging the excitement, they did something unusual. Something that almost never happens when a fund is performing well. They slammed the brakes. New investment into the fund was restricted, sharply. Limits that once allowed large sums of money to flow in were suddenly cut down to almost nothing, a fraction of what they had been just days earlier. At first glance, this might look like caution, responsible management, protecting investors from themselves. But looked at more closely, it reveals something far more unsettling. Fund managers do not restrict money flowing into a winning investment unless they believe the winning is about to stop. This was not a routine decision. This was a warning, quietly delivered through action rather than words, the financial equivalent of someone pulling the fire alarm before the smoke was even visible to everyone else in the room. And then, just days later, the fire arrived. The fund dropped by the maximum amount allowed in a single trading day. 10%. Gone, almost instantly. Investors who had watched their savings grow for weeks now watched a significant piece of it disappear before the market even had time to open fully. But here is where the story shifts again, and this is the part most people overlooked in the noise of the headlines. This was never just a story about one fund, or even one country. China's silver market operates within a much larger web of behavior. Everyday investors searching for somewhere safe to place their savings. Capital that is often restricted from moving freely across borders, and a culture of fast, collective decision-making where millions of people can shift their money in the exact same direction at the exact same time. When that kind of behavior meets a market already running low on patience, the result is rarely gentle. It is sharp, sudden, and loud enough to be heard far beyond China's own borders. Because a crash like this does not stay contained to a single trading floor in Shanghai. It sends a message to every other market watching silver closely, a message that says clearly and without apology that excitement built on borrowed momentum eventually meets gravity. And for the world beyond China, that message mattered more than most people realized in the moment. Because while investors inside China were absorbing the shock of a sudden collapse, a completely different and far more serious story was quietly unfolding across the rest of the globe. One involving actual physical silver, disappearing from vaults, warehouses, and industrial supply chains at a pace few had ever seen before. And that story was only just beginning to surface. While China's silver fund was absorbing headlines and shockwaves, a much quieter, much older story was unfolding across the rest of the world. One that had nothing to do with panic, speculation, or fear. It had to do with something far simpler and far more powerful. There simply was not enough silver left. Not enough sitting in vaults, not enough stored in warehouses. Not enough to meet the demand now pouring in from every corner of the global economy at the exact same time. This was not a rumor. This was not a story invented to stir excitement. This was a measurable, physical fact. Inventories of silver held in reserve around the world had fallen to their lowest levels in recorded history. And here is the twist that changes everything. At the very moment silver was becoming harder to find, the world's appetite for it was exploding. Solar panels needed silver, vast quantities of it, embedded into every single panel being installed across deserts, rooftops, and power farms worldwide. Electric vehicles needed silver, wired into their batteries and electrical systems by the millions of units rolling off assembly lines each year. And an entirely new force had entered the picture, one that barely existed in the public conversation just a few years earlier: artificial intelligence. The massive data centers being built to power this new technology required enormous amounts of electrical components, and inside nearly every one of them sat silver, quietly doing the work that made modern computing possible. So picture the scene forming beneath the surface: supply shrinking, demand rising from not one, but 3 of the fastest-growing industries on Earth, all reaching for the same limited resource, all at the same time. Basic economics offers only one outcome when this happens. Prices do not stay where they are, they rise. But there was another layer to this story, one that added even more weight to what was already building. Central banks, the very institutions responsible for managing entire national economies, had been quietly increasing their own purchases of precious metals. Not silver alone, but gold as well, moving steadily and deliberately, the way institutions move when they are preparing for uncertainty rather than reacting to headlines. At the same time, large pools of institutional money, the kind controlled by pension funds, investment firms, and long-term strategists, had been flowing steadily into precious metals through global investment vehicles. Quiet money, patient money, the kind that does not chase headlines but often arrives just before the headlines are written. Here is where the story takes its sharpest turn. 2 very different forces were now moving in the same direction, but for entirely different reasons. In China, the movement had been fast, emotional, and speculative, a wave of excitement that grew too large, too quickly, and eventually broke under its own weight. But across the rest of the world, the movement was slow, structural, and deeply rooted in real, physical scarcity, a shortage that had been building for years, largely unnoticed, until the moment silver's price finally forced the world to pay attention.
2 timelines, 2 very different stories, colliding at the exact same point in history. And for anyone paying close attention, the real question was no longer whether silver would remain valuable. The real question had become something far bigger. What happens to industries, businesses, and entire economies when a resource this essential, one buried inside solar panels, electric vehicles, and artificial intelligence infrastructure, simply becomes harder and harder to obtain? That question was no longer sitting quietly in the background. It was standing directly in front of every business leader, every entrepreneur, and every decision maker paying close enough attention to notice it. Every crisis eventually forces a question, and the question sitting in front of the world right now was simple but heavy. What happens next? 3 possible paths stood ahead, each one carrying very different consequences for businesses, investors, and everyday people watching their savings closely.
The first path was the calm one: stabilization. In this version of events, the shock inside China's silver fund would settle within days. The extreme premium that had built up would slowly deflate without further panic. Meanwhile, the deeper global forces, the record-low inventories, the surging demand from solar, electric vehicles, and artificial intelligence, would continue quietly pushing prices upward, not through fear, but through simple, steady necessity. If this happened, businesses relying on silver for manufacturing would face a slow, manageable rise in costs, something that could be planned for, something that disciplined companies could absorb without disruption. But there was a second path, a darker one. In this version, the cracks that appeared in China would not stay contained. Instead, they would spread outward, shaking confidence across other silver markets worldwide. Prices could pull back sharply from their recent highs, not because the shortage disappeared, but because fear temporarily overtook logic. Investors who entered the market late, chasing the excitement rather than understanding the fundamentals, could be the ones left holding the heaviest losses. Here is the twist worth sitting with carefully. Even in this darker scenario, the shortage itself would not vanish. The solar panels would still need silver. The electric vehicles would still need silver. The data centers powering artificial intelligence would still need silver. A short-term price drop would not solve a long-term supply problem. It would simply delay the moment when reality reasserted itself, likely with even greater force the second time around. And then there was the third path, the most likely one, a mixed, uneven road filled with sharp movements in both directions. Prices climbing on days when supply concerns dominated headlines, then falling on days when speculative fear took over. A market caught between two competing forces, one built on genuine scarcity, the other built on human emotion. For the everyday person, this kind of environment feels confusing, even frightening. But for business owners, entrepreneurs, and serious decision-makers, it represents something different entirely. It represents information. Because markets like this one are rarely just about metal prices. They are early warning systems, revealing where the global economy is under pressure long before that pressure becomes visible in daily life. A manufacturer relying on silver-based components, a company building solar infrastructure, a business tied, even indirectly, to electric vehicle production or the technology powering artificial intelligence. All of these businesses were now standing closer to this story than they may have realized. The lesson embedded inside everything that had just unfolded was not really about silver at all. It was about the difference between speculation and structure, between excitement that rises and falls in days and scarcity that builds quietly over years before finally forcing the world to pay attention. China's fund had shown the world what speculation looks like when it collapses under its own weight. But the empty vaults, the shrinking inventories, and the industries competing for a resource that was quietly running out, that story was not finished. It was not a headline that would fade in a week. It was the beginning of a much longer conversation, one that would continue to shape decisions in boardrooms, factories, and investment portfolios for years to come. And for those willing to look past the noise, past the panic, and past the daily swings on a screen, the real opportunity was not in predicting the next 10% move. It was in understanding the difference between what breaks quickly and what breaks slowly. Because history has shown, again and again, that the slow breaks are almost always the ones that matter most.